Hi, everyone. This is Hunter Satterfield, one of the partners here at CWA, as well as the Chief Investment Officer of CWA and a member of our investment committee. As always, I am joined by the head of our investment committee, as well as one of my fellow partners, Brian Bortz, and also the Managing Director of Tectonic Advisors, Brad Sanders. This is your June market update. For the month of June, the S&P 500 was up 6.6%. Global stocks were up 5.8%, a great month for stocks. Domestic bonds were down 0.4%, and global bonds were right at flat for the month. So here we are, guys, halfway through the year. And Brian, I'd love to ask you here in a second about what we're looking at for the rest of the year. But before we do that, Brad, I want to come over to you because we did have sort of our first pause by the Fed. We've been in this steady cycle of an uptrend in rates overall, and the most recent Fed decision was a pause, but there was some language sort of pointing towards maybe some future increases as well. So you want to talk a little bit about what the Fed said at their last meeting, as well as how the markets responded, or at least what the markets are sort of showing us they believe to be the truth for the future?
Sure. I mean, the Fed came out basically, as you said, paused, but it wasn't unanimous. There were, I believe, 3 of the Fed members that said they wanted to raise rates now. There's several that say they expect more than one future rate hike. There's one that says he thinks you should hike rates another percent. But I digress. I think that's kind of going to be what the Fed does from here on out. The bond market is always the place to look for if there's any validity to what the Fed's saying. If the Fed says they're going to hike rates, and the bond market, this last year and a half, the bond market would price it in immediately. And the Fed said they're going to hike rates 2 more times. Chairman Powell said it twice now that they're going to hike rates. And the 10-year Treasury rate is the exact same place it was, 3.8%. It's been frozen there for the last couple of weeks, basically. It moves around that number, but as it moves. So the bond market's calling their bluff. The bond market's generally right. And I think if you look at economic data, that kind of brings home our point. All economic data other than unemployment is in recessionary territory. If you look at industrial production globally, it looks terrible. Okay. And so if you start digging into that and reading about it, you'll get stuff about oil and stuff here. And, this is because of this, and this is because of that, and this one's because of this. And look, if you zoom out, to me, the simplest, Occam's razor, the simplest answer is usually the right one. If everything is moving lower, it's probably a demand issue. Right? Instead of trying to stretch and find 500 different reasons that all somehow came together at once to cause this one thing, it's probably just global demand's weakening because rates have gone up. And so when you have that happen, I think you're starting to see that in all the economic data. The market can completely dissociate itself from the economy, as we're going to see, and I think Brian's going to talk about. This isn't new. In 1998, the S&P was up like over 20%. But 460 of the S&P 500 stocks were down a lot. Okay, so we can see this kind of stuff happen from time to time. It's not that unusual, but the economic data doesn't support what the market's doing. The good news is for June, though, for the first time really this year, other stuff other than just those 7 tech stocks went up, right? We finally had, small caps were up 8%, outperformed the S&P. You had a lot of the other areas of the market sort of starting to play catch up. And that's a good sign that we might have a little bit more to run here on this bounce in the market. But I just would caution clients on getting too exuberant, declaring this a new bull market or anything. I definitely would expect some volatility as early as July when you start getting economic data and things. We normally, last couple of years, summer's been real calm. And you can kind of just ignore it. I just don't believe that's going to happen. We've got second quarter earnings and economic data coming. So that's what we're going to be watching.
Yeah, that's really helpful. And you had already referenced sort of the second half of the year. And Brian, I want to come over to you because here we are officially halfway through the year. And it's been a very positive year overall for stocks. A little bit less so for bonds, but still a really good year, from a perspective standpoint. But what's the conversation you're having with clients as we head into the second half of the year? Because we maybe haven't clawed everything back yet. So how are you talking through that with clients as we point towards the next 6 months?
Yeah, thanks, Hunter. It's a great question. The conversation that I have with clients is typically one of perspective. Things feel a lot better today than they did this time last year. But if you take a step back and look, Kane Waters is a very diversified portfolio style, and so we're not super top heavy. The top 4 or 5 stocks in the S&P are carrying the S&P still, and to prove that point, year to date the S&P is up almost 16%, but equal weighted S&P is up a little under 6. So I mean, those top companies are really carrying the market still. And the fact that we've done so well with less volatility, that we're not top heavy, that we have lower risk, all of those things are great for our clients. I try to have them take a picture of perspective. Last year was a normal event. This year is a normal event. Year to date, the bonds have only recaptured about 2.3% of their losses from last year. Last year, the bonds had the worst performing year ever. So bonds lost 13% last year. So there's still an opportunity for us to look at buying really good, high quality, intermediate term or shorter term bonds, getting some bump from that and getting some yield. But as Brad said, there is a bifurcation right now between the markets and the economy. And the economy has been fairly weak, and it's from a weakening demand. And I think that it will continue to gather strength the rest of this year. But I think the fact is that the markets are going to be fairly strong this year. The markets are looking for reasons to be resilient, and they're doing that, and they just have an economic headwind. So that's the conversations I'm having right now.
That's great. Yeah, thank you so much. And as we enter again the second half of the year, we will be back in front of you at the end of July. I hope until then you can find a nice cool place to rest away from the heat, and we will see you in a month. Thank you so much.